So what a wild environment have we been in. More and more companies are choosing private credit than banks. Actually, in 2019, private credit lending passed bank lending for the first time in history. As we move into the future, I think more and more business lending will be happening in the private lending world versus the bank lending world. So if you're a business owner and you want to access capital, you're really going to want to understand the private lending landscape and what this is going to mean for you. So stay tuned. So many people have been reaching out to me. What's up with all this private credit talk? Banks have tightened because of COVID and because of the current economic landscape that we're in. But this has been happening prior to COVID, and most people don't understand that. So really, the banks have been focused on larger and larger deals and larger companies. So really, for the most part today, banks really want to do $10 million loans or lines of credit or larger. They want to work with very big companies, and they want to park 10 million, 25 million, 50 million, 100 million, hundreds of millions, or even billions of dollars with very, very large companies. They don't really want to lend and do small loans of 500,000 or a million or 2 million, even $5 million. They don't have the manpower to underwrite those type of loans at scale, and they have the ability to park large amounts of money with bigger companies that have more assets and receivables and collateral coverage and different things that make them feel like it's more secure. What is happening though is those banks are actually lending to a lot of the non-bank lenders out there, and they're letting them go manage doing all the smaller deals. And it's easier for the banks to give them a $100 million line of credit that they go out and deploy and manage that risk and deal with the underwriting and the manual underwrite or whatever it is, the different things that a lot of these non-bank lenders, are doing. So outside of that, you have now what's happening is large companies, like even Fortune 500 companies, to middle market companies, to then small businesses that are turning to non-bank lenders or private credit or private debt options. This type of lending has been slowly gaining traction. I founded my company in 2007. We've funded over $2.5 billion in non-bank lending deals. Typically, if you're a small business to even a medium-sized business, you really have to understand this private credit market and how to use it as a tool when you may need debt. I'm not against bank lending. Like if you can get financing from a bank, like a line of credit or a term loan and really favorable terms, you should always take those terms from a bank, and you should always build relationships with banks, especially the local business-focused banks. But you also want to understand the non-bank lending options as well. And I'm seeing some of the smartest entrepreneurs, private equity-backed companies that are working with banks, with non-bank lenders, and raising private equity. So it's like a combination of all, and I'm not against any of them. Obviously, if you don't have to sell equity in your company, you can just use debt. I think it always makes sense. And even a lot of the private equity companies are turning to debt if they can get it and it makes sense for their business over giving up equity, especially in an environment like right now where you're not going to probably raise equity at favorable terms. So let me explain private credit a little bit, because a lot of people see private credit and they just think like some, private individual lending money. There are a lot of private institutions, so they're not banks, and they simply lend money. Some of them do term loan products, some do revenue-based financing, some do line of credit products, some finance equipment, some finance all. So again, going the right lender is extremely important in this private credit market, because not every lender does all of these products. And then some of those lenders focus on certain industries or certain revenue sizes. Some do deals of 10 million and above, some do deals 10 million and under. It's a very interesting landscape, and each lender has different rules and guidelines. Some of them can be big institutions. Some of them may even be publicly traded. So they can be publicly traded, but not a bank, so they don't take in checkings or deposits, and all they do is focus on businesses and lending. That's a good thing. Some of their rates are very close to bank rate terms. Some of the rates are higher than bank rates, and all depends on the risk in your business, your cash flow, your industry type. how long you've been in business for, the collateral coverage that you may have, whether it's B2B receivables, inventory, real estate, machinery. All these different things make up the risk that a lender is going to take on, and it'll make up the terms of your deal. So again, there's a lot of these different lenders out there. They all do different things. And what's great about a lot of the private lenders is typically they move much faster than banks. A lot of them can underwrite deals in anywhere from 2 to 15 days, depending on the size of the deal. Some of them can fund you in a matter of days or weeks. As you get into 5 million plus, 10 million plus, those transactions will usually take anywhere from 15 to 30 days or 30 to 90 days, depending on the complexity of the transaction. There's a lot of these non-bank lenders now that are out there, especially if you've got B2B receivables, inventory, and other type of assets that have really great products and pricing that aren't that far off with banks, but without all the complexities, without the long underwriting that a bank may take, but most importantly, a better direct point of contact that can really guide and explain to you why you're going to get approved or why not, or the things that you'll need to do in order to get approved. The non-bank lenders are typically much more entrepreneurial, kind of the way the old school banks used to be back in the day, where you'd walk in, explain your story, shake hands, and get a deal done. Obviously, it's a little bit more complex than that, but still, there's this old school entrepreneurial underwriting that really has become less and less in most banks today. The other benefits of non-bank lenders or private credit lenders is flexibility and customization. A lot of them can customize and be really flexible, whether it's in your agreements, whether it's in repayment schedules, but more importantly, they can be really flexible with you as you grow and scale. A lot of times when working with the bank, if you want to increase your line of credit or access more money, you have to jump through this whole new set of hoops and underwriting again, where a lot of non-bank lenders, once they build history, it can be really easy to work with them on an ongoing basis. And I think what a lot of the smart business owners that we work with, they just understand opportunity costs. A lot of times when you work with a non-bank lender, yes, it will be more expensive than working with a bank, but there's an opportunity cost there. If you can get a deal done in under 30 days and be off to the races in your business, yes, maybe you're paying more in interest, but if you're able to get that opportunity going today, how much more money can you make versus a 3 to 6 month process with the bank? As you grow and scale and need access to more capital, if a non-bank lender, a private credit lender, is able to work with you in a fluid and an ongoing situation as you grow and scale, constantly give you that extra liquidity that you may need, or restructure your deal very quickly, there is a cost that's worth paying for that. I've also had customers that we've gotten non-bank lending financing for, and they were able to go back to a bank, and they're like, hey, it would actually cost me less to go to a bank, but you know what? I don't want to lose this flexibility and the ease, and I'm willing to pay a little bit more in order to get that ease. And I think you have to really do the math on that. Just like working with a non-bank lender, not only can they be flexible in your growth, but they may also be flexible in a rainy day and a downturn in your business as well too. And those type of flexibilities, whether you're going up or whether you're going down your business, you really can't put a price tag on that stuff. So those are some things to really take into consideration. And I see some of the smartest people in business, private equity groups or companies that are private equity backed, that are enjoying that flexibility. They understand the numbers in their business, and they're using non-bank lenders to scale, to grow fast, to acquire companies, and to do things that they'd have to probably raise equity for and give up more equity in their business. Again, you can't put a price tag when working with a non-bank or private credit lender between flexibility, ease of access to capital, speed. All those things matter. Please take that into consideration. Thanks for tuning in to Grow by Joe. I hope you found this video helpful. And remember, financing is a tool when used the right way in your business. Keep growing, keep scaling, keep doing what you're doing. Thanks for tuning in.